Hello, and welcome to another episode of Millennial Economics. Musk said this. Today we're going to talk a little bit about patience and progress and a deep dive into every single career that would be impossible. You should save for retirement or enjoy your money now. Take that number, multiply it by 12 to get your annual number. Okay, your monthly expenses multiplied by 12. Hello, and welcome to another episode of Millennial Economics. I'm excited to talk to you today. We are going to talk about a topic, or something I should say, that I just learned about recently, which I'm really excited about. So we're going to talk about iBonds. This is going to be a high-level overview, okay? So if you are kind of the nerdy type that likes all the details, likes all the ins and outs, this is a great starting point for you. But if you're anything like me, you haven't maybe heard much about iBonds. Maybe you have started to hear something about iBonds recently. So this is going to give you a good foundation on the topic, and at the very end I'm going to give you my strategy on how I plan on investing and incorporating this into my portfolio. One thing I will say, of course, this is not investment advice. I'm going to give you a rundown of what these things are, and then I'm going to tell you how I plan on incorporating them into my portfolio. So we'll get right into it. We're going to start with a definition of what an iBond is. I'm going to read this definition from Investopedia.com because I want to make sure you guys get something that's clean, that's factual. So we will start right in on that. So what is a Series iBond? A Series iBond is a non-marketable, interest-bearing U.S. government savings bond that earns a combined fixed interest rate and variable inflation rate adjusted semi-annually. Series iBonds are meant to give investors a return plus protection from inflation. Okay, so there's your definition of what an iBond is. One thing to note, an iBond is backed by the U.S. government, right? So if you're looking for a piece of investment that's lower risk, an iBond does have lower risk because it is backed by the U.S. government and it's not tied to any stock, right? So an iBond is made up of two things. There's a fixed interest rate and a variable inflation rate, okay? This variable inflation rate follows the CPI, or the Consumer Pricing Index, all right? And essentially, again, high level, the higher the inflation rate is, the higher that CPI rate is, the higher the higher rate of return the bond will have, okay? And there is a algorithm that I'll post here, a picture, boom, there it is. That's going to show how they come up with this interest rate or rate of return for an iBond. Okay, I'm not going to go into great depths about it. Again, if you're nerding out right now by looking at these rates and how this is made up, by all means. Okay, one thing that's really, really exciting though, and why iBonds have kind of come to the forefront here recently, is because inflation has been at almost all-time highs. Okay, certainly for my lifetime. And so because of this, the rate of return for these iBonds is very high right now. All right, the current rate is 9.62%. All right, and this rate will hold until the end of October. All right, so if you're watching this video within a few days of me posting, you have a couple weeks to purchase these iBonds and capture that 9.62% interest rate. All right. Per the definition, these rates are adjusted semi-annually, okay? They are adjusted the first business day of May and the first business day of November. Okay, so what does that mean? Well, that's when the new Consumer Pricing Index numbers come out. So until the end of October, you have the opportunity to capture the current rate, which is 9.62%. That's fantastic. That rate will be reset depending on what the inflation numbers come out to be based off of that CPI data in November, all right? The cool thing about iBonds, if you were to buy an iBond or iBonds the last day of October, you will get that 9.62% rate for 6 months, no matter when you purchase it, okay? So you could purchase it today, you could have purchased it a couple months back. You will receive that 9.62% rate of return for 6 months, okay? Then, when your first 6 months end, that new rate of return that the iBond has will take into effect for the next 6 months, okay? So you can see how that kind of works. So we're in a great opportunity right now if you're looking to get a 9.62 guaranteed rate of return, and I never talk about guarantees when we're talking about investing. But if you're looking for that 9.62% guaranteed rate of return for 6 months, you can purchase an iBond before November. One thing to note, these rates are compounded semi-annually. All right, so what does that mean? Well, it means that if you invest today, you will get that 9.62% rate of return on your money, and that interest that you've earned on those funds will be added at the end of the 6-month period. Okay, at the end of the 6 months. So 6 months if you invested today, 6 months from today, that 9.62% will be added to your total, and then the money that you make for the next 6 months will be on the compounded amount. Okay, that is something to note. If you are enjoying this video as well, I would love it if you liked it. It helps with the YouTube algorithm and for more people to see this video on my channel. Also, if you're not subscribed to the Millennial Economics channel, I would very much appreciate it. It means a lot to me if you did so as well. Okay, so the question is, how do you get these iBonds, right? The only way, and I'll say this with a caveat, and I'll explain what I mean here in a second. The only way to buy iBonds is through treasurydirect.gov. You have to purchase iBonds through a government website, okay? Now, the reason why I'm making a video on these iBonds, the reason why my interest was piqued recently is that I have a high yield savings account with Yada Savings. You've heard me talk about this before. Yada Savings is a really cool company. I've held my emergency fund with them for probably over a year now. They kind of have a cool way of saving, right? So basically, for however much money you have saved in the Yada account, they give you tickets that have 7 numbers on them. Every day, new numbers come out. It's kind of like a raffle, right? Kind of like a lottery. And depending on how many numbers you match at the end of the week, you get a reward, right? So that reward, I've won anything from 40 cents up to, I think one time I won $40 in 1 week, right? Which is pretty cool. You get more tickets into those drawings, the more money you have in that account. And the account is FDIC insured and it's held with a bank. Okay, so very, very cool. They kind of gamify savings. I think it's fun. It's helped me to save more. And I've told friends and family about it and they've enjoyed the opportunity as well. But I was logged into my Yada account a couple days ago and I noticed that I could get iBonds through my Yada account. And how that works is we essentially, when I elect, hey, yes, I want to have some iBonds purchased, Yada will register me with treasurydirect.gov and they will purchase those iBonds for me. So I think that's very cool. If you're interested in Yada Savings, whether it be for a high yield savings account or to purchase these iBonds, you can click the link in the description. Basically, when you sign up, you need to make sure you use code Millennial, MILLENNIAL, and you will actually get a ticket boost when you open your account. So for that first drawing, you'll have more tickets. You'll have some free tickets, and I get a little kickback as well. So I'd greatly appreciate that. All right, so moving right along, what are the benefits of iBonds, okay? The benefit of iBond is it's a hedge against inflation, right? These rates of returns are variable depending on what the CPI is, which gauges inflation in our country, okay? So because we're in a high inflationary period, that interest rate you're going to get with these iBonds is higher, okay? It's a low-risk investment because it's a bond and it's backed by the government. It's not attached to the stock market or a particular type of company where it's going to be incredibly volatile depending on that company's earnings, okay? Also, it's diversification, right? So if you are only invested into stocks, particularly single stocks right now, you know that the market recently has been very volatile. You know the market has been going down. We are certainly in a bear market right now, okay? So it's diversification. You can slide some money in here, you can get a guaranteed rate of return, and you are on your way. All right, and some things to note about iBonds. You must hold an iBond for 12 months, non-negotiable, right? It's part of the package. You must hold an iBond for 12 months. And if you cash it out before 5 years, you lose the last 3 months of interest. Okay, so not a huge penalty here, not like a 401k when you're taking your money out and you get hit with a 10% penalty or anything like that, excuse me. But you do lose the last 3 months of interest. One thing to note as well is you must pay interest on the gains that you make on the money invested, okay? Just like a stock. Another thing to note is there is a $10,000 limit per calendar year that you can invest in iBonds. If you are married, there's 2 people, you have a $20,000 annual limit, okay? There are ways to invest an additional $5,000 every year with your tax return, and you have to do that through the government when you get your tax return or when you're filing your taxes, okay? And one last thing to note is there is a minimum amount you can invest, and that's $25, okay? So again, wanted to give you all of the items here. 10,000 foot view, right? We're not getting super into the weeds, but this is a great foundation for you if you've never heard of an iBond to kind of make an educated decision on if this is something that's right for you or maybe it's not, okay? Now, my plan for investing in iBonds. I am not going to take the money out of my high yield savings account or my emergency fund and invest it all in iBonds, right? Why? Because I have to keep my money there for 12 months. Right? And part of having an emergency fund is to have access to that if an emergency happens, right? So I will not be doing that with my emergency fund. Now, what I will be doing is diversifying some of the investments that I have in the stock market or in pre-built portfolios that I have, maybe with Acorns or M1 Finance. I will be diversifying into iBonds. I will continue to invest in iBonds moving forward. It just won't be the whole of my investment. Okay, so maybe I decide I want 5, 10%, what have you, in an iBond. I also think that iBonds can be a great avenue for short to mid-term savings goals. Okay, so if you have a goal of saving up for a down payment on a house, and you want to be able to buy this house within 2 to 3 years, maybe 5 years, right? An iBond could be a great way for you to do so. You know that this money you're saving and stashing away to go towards your down payment on your house, you're not going to need within the first 12 months, right? Maybe you're not going to need it for 3 to 5 years, maybe 5 years so you don't get that 3-month interest penalty when you take that money out. And you know that it's going to be a stable investment, unlike the stock market, right? That could be very volatile. You know it's going to be a stable investment, and you're going to know that you're getting a certain amount of return based off of that semi-annual variability. And again, because we're in a high inflationary period right now, those interest rates or that rate of return on these iBonds is high. Okay, so I'm not going to use my emergency fund. I'm going to take a little bit from some side investments that I have. I'm going to allocate it to iBonds, but it's certainly not going to be the whole picture. So I hope this video was very helpful for you. Again, if you enjoyed it, I would love for you to like the video. I'd love for you to subscribe to the channel, and we will talk very soon.